This, all of it, is exactly the scene of a bloody car crash, minutes before it actually happens. Those exact words were just leaked from Michael Burry. He is the investor who accurately modeled and bet heavily against the housing bubble in 2008, while Wall Street laughed at him. Now he is observing the exact same warning signs. He notes that the current stock market is breathing rare, extreme air. It is climbing almost entirely on blind momentum, closely mirroring referral months of the 1999 dot-com bubble. Burry's hedge fund has quietly deployed millions in bets against the broader market, blacklisting 9 specific global stocks. These 9 stocks are the center of Burry's thesis. If they are in your portfolio, you are holding the exact assets he believes are most vulnerable to the coming correction. Before we examine the multi-million-dollar bets against the current AI giants, we have to look at the first category of stocks Burry completely liquidated to zero. He dumped them because of a hidden poison in their financial reporting: accounting shenanigans. To see why these companies are dangerous, look at how they manage their ledgers. Many major corporations are currently leaning on practices that distort stock-based compensation and use artificial depreciation. They do this to make their profit margins look flawless to the public. Burry identified these exact distortions, so he completely eliminated his positions in stock number 1, United Health Group, and stock number 2, Estée Lauder. This chart compares how Wall Street views the Inexos against Burry's math. The consensus believes the market trades at a reasonable 30 times earnings, but strip away accounting tricks and adjust for reality, the market actually trades closer to a staggering 43 times earnings. The safety retail investors think they are buying is a mathematical illusion. The underlying valuations are stretched far past their breaking point. This overvaluation isn't isolated to domestic companies. Burry is also spotting severe macroeconomic cracks globally. He recently executed total exits from the massive e-commerce giants, Alibaba and JD.com. He also liquidated his entire stake in Mercado Libre, the leading e-commerce player in Latin America. When a renowned deep value investor abandons the biggest consumer goods platforms across multiple continents, it points to a serious anticipated drop in global consumer spending. This creates a stark conflict between greed and logic. Economic data points, like consumer sentiment, are hitting record lows, yet retail traders continue aggressively buying because the market keeps trending upward. They fear missing out on gains more than they fear losing their capital. That blind optimism is creating structural flaws in the tech and medical sectors, too. Burry exposed this by completely walking away from Regeneron Pharmaceuticals and ASML Holding. ASML is the sole backbone of global semiconductor manufacturing. If the man who predicts market crashes is walking away from the monopoly that supplies the entire chip industry, the current tech rally is resting on a deeply fractured foundation. Walking away from overvalued stocks is cautious, but Burry has shifted into an aggressive, dark strategy. He is loading up on massive put options, betting millions the market's beloved names will crash. His first massive short-shorted is stock number 8, Palantir Technologies. Palantir's chart surged 1,400% on hype, but calculating its true value under $50, Burry predicts a brutal 60% collapse. Swapping data reveals stock number 9, NVIDIA. He initiated a massive put option against the AI Ting, betting against the absolute peak of market exuberance. He is no longer the only one making this bet. Brilliant minds across the tech space, including former OpenAI researchers who now run hedge funds, have recently filed documents showing billions of dollars in put options against the broader semiconductor sector. The smart money sees the exact same vulnerability. The entire market is currently running on a 2-letter thesis, AI, that everyone assumes they understand, but almost nobody can mathematically value. This does not mean you should panic sell your entire portfolio and hold cash. Burry is a realist. His latest filings show he is rotating out of the hype and deploying capital into boring, unhyped physical health systems and insurance companies. His warnings focus on market fragility. He analyzes the structural instability that makes a crash inevitable, regardless of the exact day it starts. Underneath a euphoric market, hidden risk quietly compounds. Prices climb, but the structure weakens until a single event flips blind optimism into mass panic. History proves this cycle repeatedly. When greed becomes extreme, risk becomes invisible. And the market will eventually punish those who let emotional investing override disciplined analysis. You need to look at your own holdings and ask a difficult question. Is your portfolio built on actual, verifiable corporate earnings or pure hope? Because when hope runs out, the drop is merciless. Hit that subscribe button right now to stay ahead of the smart money before the next whale fall, and I'll see you in the next video.